Hello, everyone, and welcome to the new decade. Hopefully, everyone had a great holiday season and a very happy New Year's. This is Ismail Ray Reyes, and I'm here to provide you our January 2020 update. And I want to cover a few things in this update. A couple of obvious ones here. I think we all come into this new year and we have some reflection time to look at what we did in the year before, and then we have some New Year's resolutions that we put together. And yes, this is this is a few weeks into January, so I wonder if there's any New Year's resolutions that have already gone by the wayside. I have a blog post, and I'll put that down below, that talks a little bit about how to create goals that are more easily implemented and therefore easier to accomplish, I believe, because I think it breaks it into chunks. And again, I'll put that down below in the comments. But let's move on. First, I'd like to start off by talking a little bit about what MI Real Estate was up to last year. And I will caveat this first one. I am proud of the fact that we were able to acquire two multifamily properties this last year, as many of you know. My caveat is that the second property was actually closed on 3 January. So the bulk of the work, 99.9% of the work, was done last year. So I'm going to go ahead and chalk that up to last year, because I do want to have a fresh set of goals for this upcoming year. And we'll talk a little bit about that as we go into 2020. But I also, last year, some of the things that I did personally is I sold two single family properties that I had. And if you guys have been listening to some of this before, part of what I'm trying to do is, and I've done, is transition myself personally and this company into out of the single family space and into the multifamily space for a variety of reasons, all of which have to do with improving the return on investment for these properties, and frankly, to do it in a way that is less stressful in many ways than and more profitable than as I mentioned, than single family. So I sold two properties this year or last year, and I still have, the last sale was actually in December, and I'm looking forward to transitioning that money into the next multifamily deal that we come across. In the business itself, one of the things that we started doing was focusing on partnerships, and what that means is there's two ways that we focus on partnerships. One, yes, as many of you know, we look to partner with other investors, whether it be active investors or passive investors, to accumulate monies that we can use, or capital that we can use, to take down some of these bigger deals and bigger properties. But the other piece that I refer to when I talk about partnership has to do with how we're acquiring these properties. Because particularly in the areas where I'm looking for property in Florida and the Southeast, because it is highly competitive, what we've done is we've partnered with other people that are actually finding these deals and partnered with them on raising capital. And therefore, we combine those efforts instead of both entities trying to go after the same property. In many ways, we do to some extent, but I think at the end of the day, we're all trying to do the same thing, is trying to acquire properties. So if we can combine those efforts and support each other, it'll allow us to get into more deals. And so the particularly the second property, that was key, because it was a long time after we found the first one. In fact, we closed on the first one, a 59 unit, in July, and it wasn't for like 3 months later until we were able to find another property that made sense. And it was a property that we were partner with somebody else who actually found it. And so I think that's the key. So again, partnerships when raising capital, and also partnerships on who finds the deals, and combining efforts in order to acquire these properties. Jumping into 2020, one of the things that I'd like to do this year is increase our acquisitions. And again, using that strategy, we want to go ahead and at least double the number of acquisitions that we had the year previously. And not only just double them, but also look for potentially properties that are a little bit bigger. When you scale in multifamily, it usually means less risk, and it also means sometimes, in many ways, a better value because you're able to reduce some of the costs, the redundancies that you would have to do whether you have a 50 unit property or a 100 unit property. There's just certain costs that you have to cover. So the larger the deal, the larger the number of doors, in many ways, the better your chances of really getting a stronger return on your money. So we're looking hopefully this year to look at 80 to 100 units, and if not higher. We also want to diversify the markets. As many of you know, we focus a lot in Florida. Florida, for a lot of great reasons, is doing very well. It makes sense to invest here. But there are other markets. For example, Texas. Texas is a great market. In fact, I got a trip going out here at the end of January to go visit some properties out in Houston. I'm very familiar with San Antonio. That's where I had some of my single family properties from previous. And so we're definitely looking at those markets as well because I think they do have a lot of potential, particularly as we go into the agreement, what used to be NAFTA, which is now the U.S. Mexico Canada agreement, which means that there's going to be a lot of trade and a lot of jobs flowing through that middle region, coming in from Mexico all the way up to Canada through Texas and the Midwest. And so I think that's going to continue to be a very nice area to look for properties, for multifamily properties, because you're going to have a lot of workforce in those areas and growth, particularly in Texas because of those other dynamics. It's very pro-business, it's very pro-landlord, which is always good. So that when we have tenants that are not doing what they need to do, that it's not a process that takes 90 days to 120 days to go ahead and get a new tenant in there. It's a little bit less time to be able to kind of rotate through and make sure that you have tenants that are actually compliant with the rules and the payments. One of the other things that I think we're going to have to do again because of the competitiveness of this market is we're going to have to continue to combine efforts and look for properties. And when we're not the ones that actually find the properties, teaming up with other entities and other multifamily investors that do have the property. And it's not completely foreign. So you may see as we go into this new year some additional deals coming from me that may be from a different group of investors, but it's simply because trying to maximize those acquisitions by actually spreading out a little bit and looking across different markets and different groups of syndicators and investors. One thing I will highlight though, that regardless of who it is, I actually do a vetting process by focusing first on the location before I even talk about who potentially is doing who I'm going to be working with, and then I also vet them. So it's a dual process that I go through to make sure that we're working with the right partners to bring value to the investors. So what do we believe is going to happen with multifamily in 2020? That's the interesting question, isn't it? Are we going to continue to see what we've seen for the last few years, which is kind of a continued increase in high occupancy and steady but slower rent growth? And I think the answer is going to be yes, for a variety of factors that we'll go into. The first is we're going to continue to see housing supply shortages. You have boomers that aren't moving out of their homes. You have builders that aren't building entry level homes because it's too expensive for based on the regulations, so therefore they're building for higher end or middle level buyers, those that have already basically moved out or moving out of their entry level and looking for something a little bit nicer. And you're going to continue to see landlords that aren't going to be willing to sell their older properties to entry level buyers because the minute they do, they're going to have to buy a newer property, which may not cash flow because of the much higher price. So everyone's sort of staying with what they have to the disadvantage of those that are potentially considering buying instead of renting, and those folks will ultimately have to continue to rent. Another interesting factor is that we do have a dynamic of dynamic of potential. It's kind of a trend, really. It's folks that are renting because they want to, not because they have to. You have high earning people that, because of the convenience of renting in a particular area, are much more willing to do so than, say, go and move outside of those convenient areas in urban areas, for example, out to the suburbs to buy homes. They would much rather rent and live where they want, which is something that maybe in the past had not been so much. And you had really people that were moving out. One, I think it's because we have less children in our society, so there's less of a need to really have bigger spaces, yards, and this sort of thing. And I think that plays a role as well. So there's a lot of reasons. Then you have also older generations that are, instead of staying in these homes that they have, they may be looking to rent as a way to downsize and save some money for their longer term, to improve their quality of life, because of course they don't have to worry about cutting grass in many cases if they're in apartments. They don't have to worry about repairs or any of these sort of things that you would have to worry about if you own the property. So I think those are all interesting trends that will continue to maintain high occupancy when it comes to apartments. And the key is to also understand that when you're talking about apartments, you have different classes of apartments, and there is a lot more building going on of apartments. But what you're seeing is not necessarily the apartments that we're investing in. What you're seeing is Class A apartments being built. And the thing about Class A is that they are for high level income people and not so much for working class or middle class folks. And so the targets that we're looking at is apartments that are for Class C's. You're talking about properties that are either 1970s and 80s build. For Class B's, these are 1980s, late 1980s to maybe early 2000s. And so those are the ones that we're kind of looking at. And these newer builds, which are much costlier, we're not. Because at the end of the day, I think the workforce is where the majority of renters are coming from. So we continue to want to focus on that demographic. One interesting thing to kind of keep an eye on is that we still have this sort of, because of all of the dynamics associated with limited housing and rent growth and a lot of factors, you have certain states that are starting to take action. Many believe they're not good actions, but they're taking actions to try to control increasing rents. And so California, I think Washington State, if I'm not mistaken, or Oregon, one of the two, and then New York are really taking some steps that are making investors in those areas a little bit jittery. And while they're not selling off the property that they do have, they're certainly not, they're not going into buying new properties like they were, and in many cases they're moving their investments to other states like Florida and Texas. And so we're seeing the benefits of these investors that are starting to move into our markets that we're targeting. So those are good things. So I think that's about all I have time for this session. Please feel free to reach out if you've got any questions. I'll put my contact info below. And if you like some of the topics that we're discussing here, please give me a like on the channel here as I'm trying to grow this. And until next time, bye-bye.